Hi everyone! So seller stamp duty has just been extended from 3 years to 4 years. So when that news broke out, I had clients asking, is it bad for the market? Should I wait or should I buy? So in this video today, I'm going to break it down. 3 main things. What this SSD change really means, who it affects and who it doesn't, and why this might actually be a hidden opportunity if you know what's coming next. So what the SSD change really is, so from 4th July this year onwards, if you buy a private residential property, you need to hold it for 4 years to avoid seller stamp duty. Seller stamp duty is now 16% if you sell in year 1, 12% if you sell in year 2, 8% if you sell in year 3, and 4% if you sell in year 4. So after year 4, there is no more SSD. Zero. Who this actually affects? So this rule is really designed to target one group of people, the short-term flippers. Essentially, people who wait 2 to 3 years and quickly sell for a profit. If you're a homeowner or planning to hold your property more than 4 years, 5 years, 6 years, honestly speaking, this doesn't hurt you. In fact, it might actually protect your investment. So let's explore that a bit. So to me, there is no immediate market crash because this isn't like ABSD, TDSR or MSR. It's more of a cooling signal. It's not so much of a market break. So the real effects, they'll show 4 years from today because people who buy now can't really easily sell till 2029 onwards. So prices won't exactly crash because of this. Here is where it gets interesting. From 2028 onwards, we are expecting very low TOP supply. At the same time, HDB MOP supply spikes. So demand is going to rise while supply drops, and resale sub-sale stock will be locked up by the new 4-year SSD rule. So that's a classic setup for price growth. So if you've been watching the CCR market, you know it's been slow. But here's what most people miss. New CCR buyers from now on, they are locked in for 4 years. So in 2028, there'll be almost no resale supply in the CCR or very low, and the existing units will become a lot more attractive. This could trigger an early rebound in the CCR prices. And while all this is happening, mortgage rates currently are actually falling or likely going to fall below 2%. So you think about it. Now with lower mortgage repayments, higher affordability, more buyers entering the market, this is the kind of environment where prices tend to move up, not down. So moving forward, this is what I expect of the market. So if you're buying now and planning to hold about, let's say 4 to 6 years, which typically this is what I plan for our clients. Holding for a 5-year period plus minus, if before that you can sell, take it as a bonus. If not minimally, my advice, keep it for about 5 years plus minus. If you do that, you're not penalized. So in fact, you're actually better protected. Why do I say so? You're entering early before the real supply crunch hits, your downside is limited. And your upside? That's what we saw in 2020 to 2023 again and again. 6-figure gains for buyers who held just 3 to 4 years. Now we're talking about holding for 4 to 5 years. So what I'm advising our clients today since the morning, since the news got announced, is first, don't panic. Second, don't sit on the fence. Third, buy smart and hold long. We are focusing on projects with good entry per square foot and good growth runway. So essentially the key is plan with a 4 to 6 year horizon, not 2 to 3 years anymore. So as a final word, don't let the headlines scare you off. The SSD change is not exactly a punishment for the market. It's more of a filter. It filters out short-term noise, so serious buyers can actually move on with a lot more clarity. If you're wondering what this means for your next move, or if you're actually sitting on a fence, just drop me a message and let's plan this right together. See you!